In your view, there was no surprise when it came to today's move, but how high has Mr. Powell set the bar for any future action?
Well, I think Jay Powell and the committee have set the bar pretty high, actually. If you are looking at a rate cut, they've used the expression material reassessment, meaning that the economy would really have to show some pretty serious signs of deterioration. And then on the upside, from a rate point of view, he reiterated what they had already said, and that is a significant and persistent move into the territory of undesired inflation. They actually want a bit more inflation, but then it would conceivably go into a zone where it was undesirable, and that is a pretty high bar. So it's very hard for me to see the conditions developing, at least starting from today, where you're going to get a rate action for the next few months, and possibly the whole year.
Dennis, I'd like to ask you about the trade war. It's not resolved yet. Eventually, it probably will be, but in the meantime, it's taking a toll on the U.S. and China, countries around the world. Now, Jay Powell talked about rate cuts work with a lag, right? So obviously, I think he's reiterating they've done enough, but let's take a quick look at a very simple chart. It's the ISM Manufacturing Index. And you can see as the trade war got longer and deeper, that number has fallen below 50. It's been in contraction for what, at least the last 3 months. And a lot of people were pointing to this as what was worrying the Fed, arguing why they need insurance cuts. If the trade war continues, if manufacturing stays in the doldrums, if we see China remaining weak overseas, does this bring back the pressure on the Fed to cut rates again?
Well, I continue to believe that the principal story about the current strength of the U.S. economy is about the consumer, and that there is what I call a virtuous circle of low unemployment, historically low unemployment, that gives the consumer confidence of income in the future, and therefore the American consumer is spending, and that is driving the economy. That means that the manufacturing sector is a secondary part of the equation, and yes, there has been weakness in manufacturing. It's been weak for a good part of this year, if not most of the year, and there's global weakness in manufacturing, but it's not a big enough component in the overall economy to derail what is really being driven today by consumer activity.
There's weakness also in inflation. Jay Powell was saying that for rates to move up, there would need to be a significant and a sustained move up in inflation as well. But no inflation around the developed world seems to be the norm. How long might we be waiting for that to happen?
The concern, I think, that they have front and center, that is the Federal Reserve and the FOMC, is inflation expectations. And the decline in inflation expectations over the last actually few years, to the point where today the expectations seem to be anchored fairly significantly below their target, say 1.5 to 1.6%. I think that is very much on their mind, because if they let that continue to be the expectation on the part of the public, it can really, in effect, turn the U.S. economy into a chronically weak demand environment, and that's what they want to avoid.
Then is one of the most pressing issues right now in the month of December seems to be the year-end funding squeeze that we could see. But Chair Powell only saying that they're focusing on the year-end, but not really talking about a long-standing standing repo facility. What do you think of this?
Well, I know they have been considering a standing repo facility, but as I watched the press conference this afternoon, I agree, because you just explained what he said. He said they have these temporary measures where they're trying to inject liquidity into and reserves into the system and support the repo market. But he went on to say that at some point, probably in 2020, they may stop that activity, conceivably even reverse the growth that they've had in reserves, because they will feel that the market conditions have stabilized and that they've got the reserve levels at the appropriate point. And that is something that I took note of, as you did, in today's meeting. And he did not seem to indicate that the standing repo facility was something they were going to make a decision on in the near term, and therefore it was very likely in the near term.
In fact, he said it wasn't really one of the things that he was focused on much right now. What's the biggest risk to this policy, Dennis? Inflation's below target. It's been there for a long time. The Fed's talking about putting in a range. Maybe that exonerates them. Is it a concern that maybe inflation remains low and the economy is a little more vulnerable, or do you think it's smooth sailing for the next couple of years?
Well, starting from where we are today, I would say that the outlook is for moderate growth. Inflation, I am prepared to believe that inflation will begin to edge up. I take the tightness of the labor market and the slight acceleration in the growth of wages as probably playing through to inflation. So I think finally their forecast of inflation may very well play out. And then we have employment at numbers that no one believed really were possible. 3.5% unemployment, with a very strong picture of job growth in the last report. That will probably continue to some extent. So the economy overall is in a very good place. The growth number could be stronger, but I think realistically in today's environment, global environment, a 2% rate of growth is really a quite decent performance of the economy. And I really can't see today that changing over, let's say, the course of 2020.